traders might not seem the most important topic, but in fact it's definitely worth your time that you're here. So we're glad that you could join. And as you know, we're going to just do some quick messages at the beginning regarding, for example, the risk disclaimer that used to be at the beginning, but I see isn't anymore. Okay, I changed it apparently. So welcome once again at Admiral Markets, where you can see great advantages, great spreads, as you can see with our trading room as well, live as today, yesterday, and Tuesday. Before we start this educational webinar, though, please note that trading global financial markets in general is considered high risk. It may not be suitable for all investors. Just please seek the advice of an independent financial advisor for more information on that. And this recording and webinar is for educational purposes only. So we thank you for your attention on that. And we're going to look at stop losses. So we're going to take a look at all the angles of stop losses, what they are, why we should or could or must use them, and disadvantages and advantages of those stop losses, which types of stop losses we have, talking about moving stop losses and where to place them. So you can see a lot of stuff to cover in 1 hour, so I'm sure you're going to enjoy it. And we're going to start with just a simple explanation, what it is.
Yeah, let's start with a simple explanation, what stop loss is. And basically, this is very, very important. The stop loss, it's an order which limits investors' potential loss on a forex position. It's also known as stop order. So let's presume that we have a short trade. For example, we have a short trade in the market, and that short trade isn't going like we wanted to, so it hit the stop loss. So what happened is basically it's in the background. When stop loss is hit, it's an automatic buy into the market. So when your stop loss is hit, your order is practically being bought, and then you're stopped. But you're stopped as a stop loss. So that is almost the same as hedge, having both positions, having two positions simultaneously opened. So that is, for example, you have a short trade and you have a long trade, and when you open it at the same time, that means that you only pay a brokerage fee. So hedge is basically what stop loss is. So if you have a sell, that is automatically buy into the market. If you have a buy trade and your stop loss is hit, that it's an automatic sell into the market. Stop loss is very, very important, and it's definitely one of the most widely used orders in Forex automated and manual trading. This is very common thing because trading has become really a day job today. And as always, when we trade, I suggest having a stop loss order. And I will show you what types of stop losses there are on the market. And basically, since this order type has existed, there has always been significant skepticism around it, as many do not consider a good thing for the broker to know the exact place where a trader wants to exit the market at a loss. And that sheer fact that that information is shared with the broker allows not only foul play, but it enables the broker to figure out our intended risk proposition. That is what I don't doubt using Admiral Markets. So one of the reasons why I went with Admiral Markets is that they basically don't do that foul play. Many brokers, I won't name those brokers now, but many brokers that I used prior to my switch to Admiral Markets just exploited that fact that I use stop orders, and I use it every single day on every single order. So one of the most important aspects of trading is undoubtedly that risk control. So we always need to have that, and you shouldn't be afraid of that thing called slippage. Many traders ask me what slippage is, and when stop loss is executed at a given price, but the market is very volatile, that means that the market couldn't find that exact price. So it goes by the first order after that in which it can found that and that price. So that is called slippage. And stop loss is stopping the loss, and that is why it's called stop loss. It's basically stopping the loss. We all, as traders, must have a predetermined exit before we have even entered. We just need to know what our risk is, and as always, we base our money management according to stop loss. So there are many advantages. There are several disadvantages, but advantages outweigh the disadvantages. So surely there is advantage in having a stop loss. No matter what kind of stop loss, I prefer technical stop loss. Some prefer mental. Some prefer equity. We will see what types of stops there are. So always consider a stop loss prior to entering the market. And if you experience a slippage, that means that the price couldn't be found at exact price that you have put it. Then that the very first price, what it was basically where it was found, buyers or sellers. It depends whether you were short or long. So Chris, let's see another slide.
That definitely makes sense regarding also pre-planning the stop loss.
Yeah, tell me, what did you have in mind? What did you have in mind?
Definitely a very important thing. I think most of us probably who've been trading here for a bit longer definitely do that. But maybe if you're new to trading, that maybe is not that regularly done. Definitely an important thing to realize your trading plan, and which is of course stop loss is a very important key of that trading plan. To realize what it is before actually entering. I think that's probably people who've been trading for a little bit longer do that automatically, but for maybe people who have just started, that's a great tip. This is just a slide actually saying a bit the same, but just emphasizing also that the stop loss here at the bottom, giving an example, that the stop loss right in here is also of course a part of the calculation for the lot size. If you were to use, for example, 1% of your trading capital and you have an X amount of pip risk, then you can calculate what your lot size is, for example. So that influences that. Also influences other stuff. We'll talk about that a little later. Just for the fun of it, I heard also people calling stop losses take losses because they think it's take profit, and they call it the opposite of take profit, take loss. I call it stop loss, but I thought I would mention that some people call it differently. Here, just a general idea where you could use stop losses, for example, above major levels. We'll dive into that a bit further when we discuss technical stop losses. So my view on why do we need stop losses, and then Tarantula is going to discuss some slides regarding disadvantages and advantages amongst others. But before we do that, I wanted to just mention that in a way stop losses really connected to leverage as well. If you think about it, if you take your own money and you go to a foreign country, for example, if you go to a holiday and you take your local currency and exchange it to your Forex currency, and you have some left at the end of the vacation and you re-exchange it back to your local currency, it's of course you're not using leverage. It's a one-to-one relationship, and the risk with that is really little. I mean, there is some currency default risk maybe that is higher or lower depending on the currencies, but it is your money. You fully own it. The only thing that you could lose is the hypothetical difference in exchange rate, right? But you own it. Now, if you start to use leverage, of course, that's when the risk increases in a way, because then you're borrowing money to trade, right? So then the fact kicks in that because we are borrowing someone else's money against our own capital, at some point of time, the margin is going to dry up, and that's why we need stop loss to protect our trading capital, right? That's the real reason for a stop loss, a technical stop loss at least, because otherwise the fact that we use a stop loss doesn't necessarily have to protect the trade, in fact, because if we were trading one-to-one, we could wait a lot longer and the price would maybe eventually come back to our entry level and nothing happened. But because of that leverage, because we want to maximize our potential profit, and we have that risk, we need to protect our capital at all costs. Our trading capital is basically our stock. If we're a company and we're a retail seller or a wholesaler, our capital is our stock. If we don't have capital, we can't sell any goods, basically, if you would translate it into their model, retail seller store, for example. So we need to protect our capital and our stock to make sure that we can trade another day. That's why a stop loss or equivalent of that is important.
Yes, there are many advantages and disadvantages of using stops, but as I said, advantages simply outweigh disadvantages. So, what are advantages of using stop loss? So, basically, the first and the main advantage is to stop our loss. That's why it's called stop loss. It's stopping our loss, further loss of our equity. And as Chris said, it is always used when we have a leverage in our trade. If we do one-to-one, we don't need any stop loss, of course. But with one-to-one leverage, it's hard to make any big money. So basically, that is why we use some sort of leverage. For example, most of us are retail clients. We have some accounts. I want to say how much money we have, but basically all below 100,000 units are considered retailers. So we can do for a hedge fund, we can work for a investment fund, for some sort of capital fund, but basically when we trade with the leverage, we are considered retail traders. So very important thing is that not using it on leverage trades that can end our career in Forex market. And if we don't have money to fund our accounts, margin call can end our career in just a few hours or a few days. I know many successful, ex-successful traders which were very successful, doing very good trading with institutional clients, and they just disappeared. And when I was asking about them, I was told really that they have blown up a lot of money, and they needed to switch again to a day job and to try to find another job to make living. Forex, making a living in Forex, it's not easy. It's really hard to do it if you don't have much capital. So basically, we use our leverage to raise our capital, but always, and I just mean always use a stop loss. Even if you have a 1 to 5 leverage of 1 to 3 or 1 to 10, you always need to have stop loss. The next advantage is that a quick exit of the trade when it goes below or touches the stop loss, and a peace of mind. What that means, peace of mind? That means that you can be very peaceful if you set your stop loss. First, that platform will exit you at the first available price, usually hitting your stop loss and stopping your further losses if you sleep. If you are, for example, out of your trading platform, or for example, you are going to have a dinner and you have a trade, or you are going on your vacation and you set up some intra-week trade. And of course, you don't need to watch every single moment. You don't have a computer. Maybe you will be traveling, I don't know, for 12 hours. Then you just simply you put your stop loss and you have the peace of mind. Then again, having a stop loss means that you are disconnection proofed. Every time platform disconnects, it doesn't matter, it will respect your stop loss. if there is a brownout, if there is a blackout, again, you can safely rest assured that your stop loss will be hit and and you will stop further losses. Also, platform malfunctioning proofs. That means if something is wrong with your computer or with the platform, again, platform will respect your stop loss because it is written in the center server. So basically, you don't have to worry about platform malfunctioning. And basically, using stops has really a lot of advantages. So you basically, it all sums to that you are using an adequate control of money which is put at risk on every single trade, and that is the most prominent advantage of using stop loss. Of course, as always, not everything is brilliant. Not everything is brilliant. So there are some, not many, some disadvantages of using stop loss. First of all, you need to know background of your broker, and this is one of I may say internet myths about brokers. Basically, when I switched to admiral markets, I was asking around a bit. I had some friends and they told me that I didn't have to worry about anything. And really, all this time, I have never had any problem with spiking the stop loss. And believe me, I know how to see that the stop loss is spiked. And that is why I'm rest peaceful. I rest peaceful when I really put money in admiral. So I'm just an outsourcer. I don't work for admiral, but I use my and manage accounts in admiral account. So the first thing, why brokers? As I said, when we enter our stop loss with our broker, I'm not saying about admiral, I'm saying about other brokerage, but I won't name it. Most of them, they become aware of how many pips the market needs to move before we are taken out. If there are enough stop loss orders near price level, they can fake through regular fee dependency. And most of them will do that. And why is that happening? Because that happens because there is no central exchange on the Forex market. And that kind of broker can easily fake a deviation of a few pips if it means to take out clients and pocket a good amount of profit. So they just spike for 2, 3 pips, 5 pips, and it's taken in a second. Why they wouldn't take advantage of that possible source of profit? They would. And then we need to assume that they will take advantage of our known stop loss and take us out to the pip. And does that mean that we should never use a stop loss on our system? Of course, no. And the truth is that not using a stop loss with MT4 broker is a very dangerous practice, since there are many things that could go wrong, which can make our system unable to exit a position due, as I said, due to disconnections, over server issues, or some other problem. So entering an order which already has the exit in place is a very good practice, and which really will make your broker honor your exit with much more accuracy. So when you choose brokers, of course, you need to choose honest broker, and that is why I really rest peaceful when I set my stop loss. I always set my stop loss order. Sometimes I use mental stop order. For example, I will tell you the truth. I will tell you the truth about it later. What happened to me yesterday when I used that mental stop, but I was driving a car and I was trying to make a trade. And that is what I never do. after yesterday, I won't do that never, really. I suffered some drawdown of overall, I think it was 10% of a drawdown. Just the phone was picking some trades randomly, And when I stopped, when I was stopped on this, when I was trying to exit my car, I saw some orders opened. And then I was thinking, oh, when the hell I did open, and all orders were in a loss. And then I saw that basically I didn't do it. It was just my phone. My phone was in my pocket, and the platform was on. The platform was on, and while I was driving, it hit some buttons and opened I think it was three or two or three orders simultaneously. So I had a cable buy, I had a cable sell, then again I had a cable buy, and all that were leveraged. That wasn't a pure thing, for example, one-to-one leverage. They were all leveraged, and they were all hugely leveraged. So what that was incredible, and I suffered. I think I suffered from that particular. I need to close it immediately, and I suffered around about. I think it was from that particular. I can say trade, but it was not my trade. It was randomly opened. I think it was 6%. I went 6% in a loss. So that was, yeah, that was really,
really unfortunate.
Yeah, very, very unfortunate. Guys, believe me, always use your stop orders. What would have happened if I didn't see that my orders were opened randomly by the phone? I just couldn't imagine. So I was really sweating. I was really out of myself. That is something that has never happened to me before, and now I need to cover the loss. And I was really out of myself. It was it happened in 20 minutes. So it was not yesterday. It was day before yesterday. Yesterday I had only one. I think only one trade I made because I wasn't out. I was out of my platform. And I saw that it hit my projected target level by my analysis, but I couldn't have traded it just because that happened to me day before yesterday, and I didn't want to trade by the phone. So from now on, I think that I will remove the platform from my phone, and I will always use my trading station to put a stop loss order if I'm not close to it. So I won't use the phone just because of that reason. I'm not sure that it won't happen again in my pocket. Yes, someone maybe would say, why didn't you lock it? Just because I have an automatic lock on my Android, but also that wasn't working yesterday. It wasn't locked. Somehow it wasn't locked. So it happened to me, and believe me, guys, I will finish with this part of brokers awareness of stop loss orders. We say using Admiral, you don't have to worry about it. Then psychological failure when stop loss hits reverse. That happened to me yesterday. It was not my fault for that 6%. And the third disadvantage is if it's placed in the wrong place or time. So we are entering a buy or sell, but we are entering at the wrong time. What happened today is my early morning analysis suggested that we are going to go to above 32, exactly 32.75. I think that we will go just around 32.50, maybe today, maybe tomorrow, but it was long all the day. But for example, someone entered just at the break of 32 level. Then there was some news. I think that was unemployment news, and every trade would have been stopped out if that particular trader hadn't used a stop loss of 40 pips. So that means that order is placed in the wrong place or time. I don't want to place order prior to news. I don't place order 30 minutes prior to news, red news. I'm talking about big news. So that means that some sort of disadvantage, but it's a small disadvantage. So that is a small disadvantage if we don't respect trading hours or we don't respect entry level. So basically, that is what I wanted to tell you. Always use a stop loss, even if you are sitting close to your computer. You just don't know what can happen. You just don't know what can happen. So, Chris, do you agree with me?
Yeah, absolutely. That makes a lot of sense. And That's the best advice. Probably you might have heard it before, but it definitely makes sense. And we just want to emphasize that. And if you feel uncomfortable with using a stop loss at any particular time, then maybe it could be then a bad time to actually trade, right? So it could be wise just to be a bit more patient and wait for a better setup. There are tons of setups, tons of movements, tons of currencies to look at. So no reason to be impatient and chase the trade as maybe some Forex traders do at the beginning of their careers. All right, so, well, basically, I was talking about that protection of capital, right? And the stop loss is definitely what I would say is the preferred method. As Tarantula said already, trading without leverage or one-to-one is you got to have a lot of capital, with emphasis on a lot. So some people do use those soft stop losses. I've heard that before, and those are really only traders with a lot of experience that use day charts. And the only reason why they use a stop loss, a mental stop without really an actual stop loss, is because they don't want a daily wick to go through a level. They're looking for a daily close above a certain level, not a wick, and they don't want a wick to take them out. So I've heard about that before. So, but yeah, that's one way, I guess, of protecting capital. But that's probably when you use that's for sure when they use low leverage. Very small percentage of their account as well, all the risk and money management that you can imagine, and long-term time frames. All right. Then hedging outside of the U.S. people sometimes do as well, right? But the most common option, right, stop loss to protect our capital. We'll be talking about stop losses now a bit more. Just a general note about hedging that it is in the U.S. not possible, but outside of the U.S., definitely something very difficult, I believe. Tricky, needs a lot of practice, and you need a lot of experience because you can get yourself caught in a jam and messed up pretty fast if you're not careful. So be very careful with that. Let's see. Now the stop loss, of course, has some disadvantages. Tarantula already actually talked about a few of them. So I won't elaborate on that. But basically, the biggest thing about stop losses, in my opinion, is that the entry with a wider stop loss is the timing is less important, basically. But if you're using a tighter stop loss, then the entry moment, the time factor is getting more important, in my opinion. So the time factor is actually something we discussed earlier with Emerald Markets webinar, and I encourage you to look at that video and educational webinar, which is dating back, I think, in February. But it should be there, so that could be interesting if you want to know more about that. And now we're going to take a look at different types of stop losses.
Indeed, there are different types of stop losses. Those are percentage stop or equity stop, technical or chart stop, mental stop, volatility stop, or time or hourly stop loss. Most commonly used is technical or chart stop. But there are also another types of stop losses, and we will all cover it. Now briefly, my preferred technique, of course, is technical chart stop, because I just like to watch those levels and base my stops on important levels. So, but there are also other techniques. So let's start with equity or percentage stop. So what is a percentage stop? It uses a predetermined portion. Sorry, Chris?
Tarantula, I think that this is just a slide that you just summarize all the things, but I think you have a specific slide explaining it, right?
Yeah,
I think.
yeah, I will explain it then. Okay, exactly,
okay,
exactly,
good.
exactly. So let's say, for example, my favorite stop is a technical stop, and that is really the most common way of setting stop loss orders. That is what I recommend to all of you, and that is what is really widely used. And when you are using it in a good time, according to your entry, but according to a good entry position, you will be stopped out just technically. That means that you will be stopped out not losing much of capital, because you're basically stopped around important technical level. So that means that you're stopped around the important technical level. And for that, you need to know where support and resistance lies, where other things are, such as technically all indicators or all horizontal support and levels are. So pivot points, horizontal support and resistance lines, well, another Camarilla pivot points, so last swing high or last swing low. You know already that is long. We have a question long time frame. I will answer those questions afterwards. So if we have, for example, a long trade, we usually place a stop loss just below a last swing low. And then that means that we are using a stop technically. That is why it's called a technical stop. All chart stops are technical. Whether we are using strong support and resistance levels, or we are using pivot points, they're all based on charts, so on price action. So that's why we call it technical stops. Vice versa, when we have a short trade, we put our stop loss just above the last high. If we use hourly pivot points, as I suggested when scalping, and for example you have a long trade, you just put your stop below the very last hourly support level. So that is how you use it in conjunction with hourly pivot points. So you use basically hourly resistance and support levels when you scalp. And for intraday trades, you use daily support and resistance levels. So that's why it is called technical or chart stop.
Yeah.
Let's see another one.
Well, actually, I had a few slides prepared on technical stop losses.
No problem. Then you can, yeah, why not?
Yeah, I'll jump in here and continue with that, and then we'll continue with the other stop losses that Tarantula just mentioned. Maybe this would have been actually, oh, it doesn't matter. But basically stop loss actually could have been a bit earlier in the PowerPoint, but stop loss, very sensitive, right, because we are, basically it's the moment that we accept our loss. It's the acceptance of in a way, in parentheses, kind of like defeat, if you were. Of course, this is not really true because one trade is just one trade. But psychologically, for many traders, it does feel like defeat, while actually we should always look at a period of time that's longer than one trade, of course. But mentally, sometimes it does feel like that. So it is definitely very sensitive to accept that moment. And it influences our trading psychology, future trades because of that. It also influences our win-loss ratio, our reward-to-risk ratio. So, you know, stop loss is definitely an important part of that risk management, money management, trading strategies in our trading plan. And also, besides the risk, really, also very psychological, all right? So it is very important to find not only a small, but also a technically correct one. And we're going to dive into that just a bit more. Tarantula did mention already some key factors that you can use to actually place a technical stop loss, but we'll mention a few more and also summarize it where you can see all the elements, okay? Because it is important to find a good spot. And why is it important? Because you want to be able to live with it. Stop losses are inevitably going to get hit. There's no way around it. We're always going to have, Forex traders are always going to have some losses or another. And it's good to make sure that not only that we have that reward to risk and we have a good win-loss ratio, but also the fact that we can live with that stop loss. So if it gets hit, we still, in a way, can live with it, and we don't get discouraged, we don't lose on our trading psychology, we don't get downbeat, etc., you name it, because we hit our stop loss. If we don't do it properly, you know, you're going to see the trade. Maybe our stop loss get hit and then it go our way, and you're beating yourself up, and you said, oh, maybe you re-enter the trade at the wrong moment again, and it just escalates from there, and that's not good. So it's good to find a technically correct one, which is good to live with. Besides the fact that the stop loss is really very important to protect our trading capital, right? We've been talking about that. So here's just an example on the charts where we can see how a stop loss entry.
This is a technical stop loss. Yeah.
Take profit can influence that R2R, right? And entry here or there can severely influence that ratio, of course. So technical stop loss is not, sorry, I lost my microphone there, is not a fixed amount of pips. I don't think that anyone necessarily in this room would use a fixed amount of pips, but I'm sure maybe if you're new to trading, you could do that, thinking that maybe a 30 pip stop loss should be good. You know, definitely not the preferred method there. All right. So using that strong support or strong resistance, definitely the preferred method for technical stop loss. Actually, we had a webinar, right, on support and resistance not so long ago. I think it was last week. Was it in Tarantula?
Yeah.
Or
it was last week. Yeah.
Or two? No, wait.
Support
or 2 weeks ago?
Yeah.
Yeah. Okay. Or 2 weeks ago. One of the two.
Well, maybe it was. I know that this was just some. Maybe it was this
Recently.
month. I know that. Yeah, recently,
Yeah.
very recent. Yeah.
Exactly.
But that is important. Support and resistance, of course.
Yeah. So definitely. And actually, a trader named Bill Williams, you've heard me talk about him more often. He recommends actually using the support and resistance of one time frame higher. All right. So that's a bit looser stop loss, so you might not get that reward to risk that tight, but it does give you a bit more time and more odds in your favor. All right. So that's something I wanted to mention. Some key elements to consider a technical stop loss, which currency pair are you trading? For example, you know, the pound dollar, more volatile, more spiky maybe than the Aussie dollar. The let's see, the dollar Swiss may be having a less average daily distance than the pound yen. So those kind of things could definitely tie into what kind of stop loss you want to place or could think about. The strategy, you know, what are you using, a counter trend, a range strategy, with the trend trade strategy. You know, a counter trend trade, you might want to think about it tighter in a way, because if it moves against you, it could travel for a while against you. Maybe if with the trend, you could think about it a bit looser, because anyhow the market is, the main direction is on your side. Which time frame are you trading? What is your own trading character and trading psychology? So are you in a way comfortable, do you feel comfortable with handling a bigger or tighter stop loss or bigger stop loss? All right, stuff like that. And the structure of the current market. So for example, here you see a downside. This was the euro-dollar downside from this year, February and March. And you see a nice channel going to the downside, nice trend. But this is a choppy part where I have the black box, and a lot of tops and bottoms really not being that respected. So you have to know which is really a key top. But smaller tops definitely being broken here in this piece. So that is not really that safe for your stop loss, as you can see. So there's just some elements that you can think of regarding the stop loss, just general questions you might want to consider when looking at stop losses for your trading plan. These are, now here you see a list of things more precisely summarized. Those 5 elements were just like general questions. These are specific indicators or tactics you can use for stop losses. Tarantula has mentioned already a few of them, so I'll just quickly go through it. For example, the fractal indicator, like Bill Williams uses, which is just top and bottom in a way, but of a higher time frame. In his case, he uses tops and bottoms, candle highs and lows. For example, a daily high or a daily low. For example, you could see the euro yesterday couldn't break Tuesday's high, right? And we came crashing. And those of you in the webinar, I was saying, remember, yesterday the euro was pushing up, but definitely not interested unless we break Tuesday's high, I was saying, remember? So candle high, very important. Fibonacci level, Fibonacci levels, swing highs, swing lows, chart patterns, supply and demand zones, key support resistance levels, invalidation levels, for those of you who like, for those pairing few who like added wave theory, trend lines, pivot points, right? Just to give an indication what you could use or what different traders use in general. My favorite is fractals personally and swing highs. Sometimes I look at candles stuff as well, just to see where like hourly low is or daily low is, 4-hour low or high for that matter. Yeah, those are my favorite, I guess. So here's an example of swing high, swing low on this euro-dollar 4-hour chart, where we can see that the currency hit the 618 and then reversed from there and fell to the first to the 272 target, then to the minus 618 target, then to the minus 1000 target, then to the minus 1272 target, and these fib targets. Anyhow, that's a different matter, but working very cool, as you can see. If you like to use actually those fib levels or just use fibs in general, we have actually a webinar on that as well, right? That in the past. Anyhow, so generally speaking, this is the stop loss, the preferred stop loss above the swing high, swing low. I know many traders that try to minimize the stop loss by putting it above the 618 or above the 786. It's possible. I'm not saying that it's not possible, but you do run the risk of getting hit and still seeing the currency go down. That is always possible. So you're taking a bit of more risk on that, but reducing the stop loss. I used to do that. Now I think never actually. I use the high, the swing high or swing low. All right. Let's see. Some traders, by the way, if it's a very big fib, by the way, and I don't know, depending on your trading style, if you use maybe a week or day chart, then a big fib like that would be very difficult to use to swing high or swing low. If the stop loss is 700 pips, if you're using that big of a fib, of course, then maybe supply and demand or other key resistance supports to support that fib would make sense, of course. Let's see. This is just another example of a fib, actually, that where your 618 stop loss above gets kind of touched. You see a wick here, push through, 50 fib gets respected, 618 in a way too, or not really, right? It pushes through, always hits the 786, so anything just above the 618 would have gotten touched. But if you're a price action trader, maybe you would have traded this wick here for that downside. Some word on moving stop losses, which I think ties into that psychology part as well, because the temptation could be to move your stop loss because you want to avoid a loss, and that has to do with the fact that we don't want to accept that loss if you do that, or you realize maybe a mistake in your trade plan, or not even a mistake, but you reanalyze and you think that it might hit your stop loss. So there are various reasons. If you have a concrete rule for your trade plan, that is the least. You should never move it, in my opinion. But if you really just saw that you technically punched in the wrong number, for example, just by accident, well, yeah, logically, I mean, I punched in with the euro dollar one time, I punched in 126, right? Well, of course I'm going to change it. It doesn't make sense to have a 700 or 800 pips stop loss, right? Logically, that I'm not talking about those cases, but if you know what I mean. Normally, bearing those unusual, never happening cases like what I happened with you in the live trading room, someone warned me. Luckily, you should, in my opinion, never change it, because it's just not willing to accept that kind of that loss. That's not good. Just accept it. Live another trading day, basically, because what you're doing by increasing that stop loss is just increasing the risk and exposing your trading capital to more risk, and that's not good for risk management. Suras is asking, what is risk management? Risk management is basically controlling your risk. So if you have a trading capital of X amount, making sure that you're not risking more than a certain percentage, like 1%, so that you live to trade another day, basically, very shortly summarized. And next time just accept this stop loss and analyze it and think what you could have done better and implement that just for the next time. That's what I would advise. Next time, just choose a better stop loss place, and you could avoid maybe that annoyance that you encountered. All right. There's also a bit of a, basically. So one more thing I wanted to add: the best stop loss is really where your whole trade plan is invalidated. An area that where if price were to go there, your idea for your stop loss or for your trade is just like not valid anymore. That's basically the best. Then you have to, if that's the best stop loss, then you have to just check if you have enough reward, where you have a realistic, achievable target. If that is in balance in relationship to your win-loss ratio, you have a trade. Otherwise, for you, or for us, there's no trade. Maybe for someone else who has a different strategy, but not for us at that particular time and place. So the best is really a place where you evaluate it, so that you avoid the thought afterwards like, oh, it still went my way. That's always annoying. Time factor, I already mentioned it, but basically tight stop loss, what I want to see is a quick continuation of my trade. It depends on the time frame, how quick. But I will, with a tight stop loss, I want to, and with a tight stop loss, I mean a fractal on the same time frame, the most recent fractal on the same time frame. That is a tight stop loss, in my opinion, because a higher time frame, sorry about that, because a higher time frame, I'm trying to push it off here. Okay, sorry about that. That was the phone. Because a high time frame could push the price through that stop loss if the trade doesn't materialize fast enough in our direction. If I use a wider stop loss, I'm more patient with the trade to develop. So here's some screenshots regarding. Person's calling back. Sorry about that. I'll get rid of the phone somehow. So basically, if you're looking for areas of stop losses, here you can see our invalidation levels of the added wave, where you have, for example, a push-up, which could be wave 1, and this could be wave 2, or this could be a wave 1 of 2 as well, of a bigger wave. Then you can see that that would be the invalidation level. All right. If the price goes through that level, then basically that's not the idea of your trade is invalidated. All right. So here's some fractal examples where you can see that they provide good support and resistance. In this case, support because we're in an uptrend, and in most cases, the fractal lows being nicely respected. Except here we get a bigger retrace of the market, and here as well. But otherwise, those support levels nicely acting as good stop loss places potentially. All right, until we move into here and the trend reverses. All right, now Tarantula is going to take you through the other stop losses.
Yeah, that was all about technical stop losses, which are most commonly used by professional traders. And now we will talk about how some other traders use different kinds of stop losses. So first, I'm going to tell you about percentage stop. And percentage stop is also called and known as equity stop. And that sort of stop is called because it uses a predetermined portion of the trader's account. So let's say, for example, that it uses 3% of the account. So with this method, stops are usually small if trades are leveraged, because traders usually use this stop. This stop is arbitrary stop loss, and it's usually used very close to support on resistance level. So, for example, trader has spotted that there is a very near support level, and he wants to go long. Then he just he base his trade on percentage he is willing to lose. So that is called percentage stop loss. And once the percentage risk has been determined, the trader uses his portion size to compute how far he should set his stop away from his entry. So he doesn't use technical stop loss, for example, last swing a low or last swing high or Fibonacci number or Camarilla pivot point, support, resistance lines. He preferred to use that only as a measure of how big is his position size when he determines stop loss. So how many percentage is he willing to lose? So I'm not sure that this is a good thing to do, because you know, you can be really tight stopped. That means that if the daily range of an average currency pair is around 100 pips, you know, when trade goes only 10 pips in contra direction, you will get stopped. So most of currencies have that the daily range slightly bigger than 60-70 pips. So no matter what, for this kind of trading, you need to choose low pairs, low volatility pairs. For example, pairs that don't have average ATR more than 50-60%. So 50-60 pips. Now, we don't use this kind of stuff for fast-moving pairs such as yen pairs, such as cable, such as euro. We only want to use with slow-moving pairs. So you know, if you take technical analysis into account, you won't, if you make an intraday trade, you won't make a stop that is too tight and too close to entry. We want always to take into account that technical part of the stop loss, technical part. So we always want to see where we should put the stop loss if we're going long, or where we should put it if we're going short. We don't base it on any percentage. But if you use it on percentage, that means that you're willing to risk that sum of money. You're not risking the technical part of your system. You're risking a pure money, and that is why I just don't like to see those kind of stops. It's arbitrary stop loss. It's not objective. It's purely subjective. So I don't recommend using this kind of stop loss. I personally never use it. And as a big disadvantage, there are no many entries which can be made with percentage stop, because it's usually single entry, because a trader pre-calculates the entry position prior to entering the market, and then he bases that single trade on a percentage stop he is willing to use. You know, we already talked about it. Trading is not how much money you're going to get. Trading is always how much money you're willing to lose. That is always a thing. So a real trader, a professional trader, will always tell you, trading is how much are you willing to lose. So that is why you base your entry size on, you always base it on how much you're willing to lose. Because trading, you know, from time to time we lose, from time to time we win. Overall, we want to have more winners than losers, and we want to be in profit. But as always, you need to know how much you're willing to lose. So just to get back on the main theme subject, percentage stop, I don't recommend it never with fast moving pairs. You want to trade slow moving pairs, and you want to take only into account that percentage of money you are willing to lose. So you don't trade technically with this kind of strategy, stop loss strategy. Next thing what I want to talk about is mental stop. This helped me a lot on a day before yesterday when my seller phone opened some few random trades, so I needed to use mental stop. I was driving and I wasn't able to see the levels. I knew some levels in my head because I took a look in the charts prior to my you know, that misfortune. How can I say that? It's misfortune. So I knew where should I close the trade by technical stop, but I couldn't have done it because it was leveraged a bit. Phone just pick up some random leverage, and you know, it opened 3 positions simultaneously. First it was buy sell, then it was another buy, and I was really concentrating on drive, so I couldn't see it, I couldn't stop it. I was on highway, so you know, it was really a bad day for me. But you know, I know where my mental stop loss is. So mental stop is a combination of percentage and technical stop, and it requires constant monitoring. It's usually done and placed on big volatility, slightly leveraged trades, or big leveraged trades if you like to leverage your trades a bit. I was watching my seller phone and I just saw that my mental stop is gonna be hit, so I closed the trade manually. That is called mental stop. So you don't want to risk money because you know that you are very close to, for example, technical stop. It was, for example, like 10 pips from your technical stop, but because you used a little bit of leverage, that's a lot more than that it was meant to be. So basically, it's a connection of percentage and the technical stop. So I just closed my trade intentionally. I closed it manually. So I was saved from a much bigger loss I could have had if I hadn't seen that the seller phone has opened position randomly. So if you're scalping, for example, also you're sitting close to your trading station, you usually have your mental stop because scalping is a very fast game, and you're usually, it requires some stop of 7, 5, 10, 12 pips, and we can monitor it. It's called babysitting the trade. So we babysit the trade, sitting constantly front of the screen and watching the trade, and we only close it when we see that our predetermined psychological stop is going to be hit. But we also watch the equity, and we see that that we are losing a little bit of it, and it's getting close to our technical stop, and then we might consider our mental stop. Let's say it's enough, we are going to close the trade. So the main thing of this kind of stuff is that traders watch price levels without entering stop loss order on platform. As always, you do it only if you're babysitting the trade, but main disadvantage is if there is some sort of blackout. Blackout is when your electrical is cut off, so you don't have any power in your house or in an apartment, so you cannot trade, you cannot run your computer, even UPS, uninterrupted power source. If you have it, it doesn't help. For example, in my home, because I can have the power on my computer and screen, but I don't have internet because I use cable internet. So then yet again, always try to place your stop loss in the platform if you're using an honest broker, such as we do. So your stop loss, it wasn't going to be spiked, but if you don't have it, your mental stop wouldn't help you then, because you cannot see what's happening if you suffer from a blackout. So the only thing I recommend using mental stop is when you have leverage your trade and when you are scalping on 1 or 5 minute time frame. Then you can use some sort of mental stop. Mental stop is also used when traders are very desperate. For example, a trader opened a trade and he didn't put stop loss, and then he started to lose money, but he really loses some money. So that means 100 pips, 200 pips, and the trade is slightly leveraged, and he sees in front of his eyes that his equity is being melted off, and he's starting to sweat, to worry about, he's getting anxious. Then he needs to use his mental stop, but that is called a positive stop loss, because he will get to the phase of desperation, and in that phase, when he consolidates his mind, he will usually do a good trade, and he can get out of that spiral of doom. I call it spiral of doom. I think that me and Chris showed it, that spiral of doom. What are psychological phases of trader when he loses and when he earns some money. So desperation, when he gets to desperation phase, he will usually earn money, and when he gets to euphoria phase, he will lose the money, and he will earn the money in desperation phase. So usually when we are in euphoria, we use that mental stop also, because you know we are very eager to trade and to take profits, but then we see that our trade is not going to be so good. Then we start to lose money, and we remove our technical stop, and unfortunately we use mental stop. So that can be either good or either bad. It depends how you look at it. I use only mental stop when I scalp, but those are really you know, on 1 minute time frame. Sometimes I don't hold it more than a minute, so I'm not so afraid that I will get a blackout or brownout during that particular minute. So next kind of stop, Chris, will be volatility stop, and volatility stop is a stop that some traders do, and it usually requires the Bollinger Bands or ATR indicator. So it's based on volatility per day average. That means that stops are wider this way. For example, you're using Bollinger Bands and you will place a long trade, then you place your stop just below the lower Bollinger Band. Or if you're using, or if you want to place a short trade, you put your short trade entry and then you just put your stop loss above the higher lower Bollinger Band. So that is called volatility stop because it uses Bollinger Bands, which is the measure of volatility, indicator which measures the volatility of market. Also ATR indicator, which gives us a ranging price. So some traders want to use that ATR indicator because they are just putting their stop loss below or above average true range. It's used in ranging markets when we exploit range, and there is usually when markets are somehow some kind slow, they're ranging. So we have two equidistant lines on Bollinger Bands. We don't have a trending day. So volatility stop is usually used on a ranging day with conjunction with Bollinger Band or ATR indicator. Yet again, it can be a good it can be a good strategy to use that kind of stop, because if day is low, it will help us. It's a ranging day, and in ranging day, if you use volatility stop, that won't be a problem because there is no big volatility, and we are sure that really our stop is rarely to be hit. But we don't know if the day is going to be ranging day or trending day, and that is the main problem. It also gives us the room to breathe because stops are wider. Usually target price, target profits are same. It's usually 1-to-1, the risk to reward ratio, or if you are picking tops and bottoms, it can be good reward to risk ratio, but the main problem is it gives us a room to breathe, but we don't know if that is going to be a ranging or trending day. For example, I know that many traders longed euro and cable yesterday, and they have suffered a huge drawdown. I think that some traders, what I have heard of, lost more than 20% on yesterday day. So that is really a problem. When we have a trend, we never fade a trend. We want consolidation prior to an counter trend entry. So volatility stop is basically Bollinger Bands or ADR indicator put together for a ranging market. And the last kind of stop is, I call it time stop. We have a time stop. I can say about it. I don't think if there was a problem with PPT, maybe we don't have that slide, but I know what time stop is, and I will tell you what time stop is. It's basically the candle stop. That is called a candle stop because we either take our profits or we either accept a loss at the close of a candle. So most of all time stops are stops we set based on predetermined time in a trade. So basically, for example, it could be a set of time, I don't know, hours, days, weeks, and maybe a session time. That means we are going to use only in London session or in New York session, or a candle when candle closes, etc. So maybe we use swing trade, and we decide to close our position on Friday maybe to avoid gaps and weekend even event risks. So we use time stops when we are going out of the house, when we go for a walk, when we go, for example, on a weekend. It is usually used on a swing trades, and it's usually used when traders do a heavy technical trading using candlesticks. So, for example, we have a long pattern on candlestick and it's close to support. We will close it at 1 hour close. So if we use hourly candles, we will use that candle stop and that candle target price. Or if we are using 4 hours, we will close the trade after the 4 hours has passed. So basically, what we do is we use the volatility of a given time frame to choose whether we either take profit or accept the loss. That's one aspect of time stop, and the other aspect is, I already told you, we are using it if we are going for a walk, or maybe if we don't want to carry trade over the weekend, so we close it on Friday prior to weekends, because most of traders close their orders and trades prior to Sunday and Saturday, because they don't want to risk anything during that weekend. So that is how I look at those kind of stops. And my favorite, again, kind of stop is technical chart stop. 99% of the time I set my stop loss initially when I open the trade, just below the swing low or swing high, or important hourly point, pivot point if I scalp, or important support level if I make an intraday trade. So that is how I use stop loss. So Chris, you can summarize the checklist.
Yeah, that sounds good. So just a few elements that we've probably already mentioned, but just to summarize it, some things: plan your trade before you enter, also your stop loss, right? We also said that's definitely key. Yeah, I prefer the technical stop loss, just like Tarantula, but we saw some other options as well. Always key to protect our trading capital, as Tarantula just mentioned. He heard some nasty stories there of big drawdowns within basically a very short time frame, and you know that if that were to happen, before you get that capital back, that requires quite a big return already just to get back to break even. So, you know, first job is actually not to lose the capital, and once we've reached that stage as a trader, then we can move on to actually making the profit, right? But first, let's not lose it. Let's not lose that stock. We're actually talking about stages of trading development in July, I think. That's going to be a webinar.
Yeah, that will be important webinar. Be sure to attend it.
Absolutely, absolutely. So yeah, then just the basic things about stop loss, right? That influences trading psychology. Beware of that and reward to risk. And personally, never to increase that stop loss size. Accept the loss, and just next time plan your stop loss better. In that case, learn from it. Do paper trading, do back testing, talk to other traders. You know, make it the best possible before you enter, instead of actually trying to change it after you've entered. And in general, try to remain patient and disciplined. Patience sometimes is, both of them are really key. If the market isn't in the environment that you think it isn't, you know, there's nothing wrong with skipping an hour or two or even a day for trading. Yeah, that's, anything else you maybe want to emphasize, Tarantula?
No, basically that is what we recommend is try to use those technical stops, and don't be afraid of accepting the loss. Don't be afraid if you have a losing trade from time to time. You need to manage your capital with a good risk and money management, and you will be safe. So whether you're using technical stop, or maybe you want to use time stop or ATR or mental, it depends of your trading style. But I personally and Chris also suggest using a technical chart stop, so you will be safe. There is nothing to worry about if you don't leverage too much, and if you use stop loss to your advantage. So if you have a 50 pip stop loss, you will use a very, very small leverage. And if you are sure about your trading strategy and you have 15 pip stop loss, you can use a little bit of leverage. But then again, you need to respect your stop loss. If you suffer from it, don't be afraid, accept it, and you will see, you will always feel better that you know that your that your loss is being cut off. So that is the thing you need to worry about. That is what I just want to say. So it's really something that we all need to accept that. We shouldn't be afraid of taking stop loss. So Chris, I think that we have made today that we have made it to the end. So yep. Basically, what I suggest is, if you're not sure how to use it, those different kinds of stop, try to demo it before going live. So just yep. Be patient, as Chris said. Use hedge, don't leverage a bit. Then when you get a feeling for it, then you can try to experiment with slightly more leverage, and believe me, you will be all right.
Absolutely, absolutely. So we hope that this webinar will give you a good building block for that in the future, in your future trading endeavors, and I'm sure it will. But definitely that testing yourself on demo, looking at the charts in the past, and live trading, live testing, of course, on demo, very important, will all help. Great stuff. So we thank you for your attention.
Yeah, and we thank you for your attention. Yes. And next webinar is development stages as a Forex trader. Don't miss it. Maybe you will find out something that you didn't know of yourself. So development stages as a Forex trader, from beginner to a pro.
That's the next one, yeah?
Yeah, next one.
Ah, cool.
So guys, many green pips to you. Read our analysis. Like Admiral on Facebook. Read analysis on Facebook page and Spider's Den, and attend Chris live webinars. So I wish you all great weekend and many green pips. And yeah. Be sure to check from time to time the video archives that we can put our videos in, because we will have a lot more to talk about.
Oh, absolutely. There are a lot of webinars coming up, also in July again. Not only these educational ones, but as Tarantula also mentioned, Tuesday on June the 25th, we'll take a look at the live markets again, 7:45 UK time, Twitter and Facebook, as Tarantula was saying, and take a look at the website where you can see those great spreads. Indeed.
Yeah.
So have a great weekend, everyone.
Yeah. Cheers, and talk to you very, very soon.
Cheers.